Iran and Israel are now, to all intents and purposes, at war. Oil price goes up at 9%. That's totally logical. Gold goes up. That's totally logical. US equity market doesn't care. That's a bit odd. Because, like it or not, it will matter. I just feel that we are in a situation where markets become choppier and more uncertain, and that holding more hedges is a better idea after 10 years of them largely being a waste of money.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the JR mining guy over on X, and of course, your host of this channel. And I'm looking forward to bringing on a first-time guest. My guest made billions during the global financial crisis back in 2008 by trading volatility. He ran a very famous hedge fund, and as I said, he made a few $1 billion doing so back in the day. Now they're considering or are reopening that fund 15 years later, and we have to discuss with him why that is. Like, what is he seeing in the market that has changed so dramatically over the last 15 years that he has to come back and play this volatility that he's seeing out there? So lots to discuss. And before I switch over to my guest, let me remind you, hit that like and subscribe button. It's a free way to support our channel, and we tremendously appreciate it. Now, I just realized I didn't mention the name. It's Steve Diggle. He's the founder of Vulpes Investment Management. Steve, thank you so much for joining us here.
Hi, Kai. Great to be here.
Yeah, looking forward to this conversation, Steve. As I said in the intro, you made billions back during the global financial crisis, and now you're back. The question is, we have to discuss, like, why are you coming back into this market? What are you seeing? So let's start framing this discussion by maybe getting an overview of your current macroeconomic assessment here.
Right. I mean, so pedantically, we didn't go away entirely. What we did is in 2011, we shut our long volatility funds. I co-founded a hedge fund called our Traders Fund Management, which was based in Singapore from 2002. And we've been continuously operating since then, but we haven't operated our long volatility fund since February 2011. We made the decision to shut it in October 2010. So it had been very successful in 2007 and 2008. We were able to make about $3 billion for our investors, which pretty much doubled our AUM and our NAV. But we saw that macro conditions, particularly the roles played by central banks in creating massive amounts of liquidity, were likely to reduce volatility in the medium term, which is certainly true. It has been the case. But here we are at the start of 2025, and we feel that there are three critical things that have changed, which are likely to make markets more volatile than they have been in the past decade. And those three things are, one is that asset prices, especially US stocks, but asset prices broadly have inflated a long way, partly due to this rampant and unprecedented money printing we've seen from most central banks, including the Fed. We've seen debt to GDP ratios rise to levels that are very unusual in peacetime, and there doesn't seem to be a lot of political will to reduce them, or even, you could argue, much desire from investors to see that either, because they're not punishing the deficits yet. So one is asset prices have become expensive. The S&P has done phenomenally well, especially the US markets generally. But, at 23, 24 times earnings, it's now pretty expensive, especially as there's some clear headwinds for an acceleration of profits, not least the US economy. It also happens to be, the risk-free rate. I mean, a PE of 23 equates to an EP of 4%. And that's the risk-free rate. So the equity premium is very high indeed. In fact, we have only the last time we saw a market this expensive versus risk-free rates was in 2000. And as a consequence, and everyone knows what happened then, right? Well, it's ancient history to a lot of people, but I remember it. I mean, NASDAQ eventually fell 80% from that level. So markets are expensive, and given where rates are, they don't give a lot of room for disappointment. In fact, you'd argue very little at all. Secondly, the money printing that has occurred eventually led to this resurgence of inflation. Inflation was, as it turned out, not dead. Summer of 2022, US inflation reached 9%, a level it hadn't seen since, for 50 years. So the room that the Fed and other central banks have now to continuously solve all problems by printing more money is down. You can see that in Chairman Powell's reluctance to make commitments around cutting rates from here. Inflation is proving a little sticky. It has obviously come down away from that 9% level. But if the fire brigade for any problems in markets was always the Fed to come along and hose it down with get more liquidity, that resource is now strained. So you have expensive markets and you have a limited ability to for the Fed to intervene. So the Fed put, I feel, is a lot thinner than a lot of people imagine. And the third factor is, after the November 5th election of Donald Trump as president, whatever your views on the president, I think it's very hard to argue that he won't be a catalyst for volatility. He has an administration that wants to shake things up. They see lots of problems in the world order and they want to change them. So you put those three things together: expensive markets, expensive equity markets, expensive and complacent, I would argue. A limited ability, a decreased ability of the Fed, having taken what US debt to GDP to 127, 128% of GDP, very high level for a peacetime economy, and the world's reserve currency. And then someone in the White House who is both very strong because his will through Congress is very high, and with a tendency to shoot first and ask questions later. I think whatever is going to happen to markets, they are going to become choppier. They're going to give more surprises to investors, and volatility is going to increase. So that's why we reopened this fund to be exposed to be in long volatility.
No, fantastic. Yeah, lots to follow up on, of course. Really good overview there, Steve. Volatility, of course, has risen, but maybe we'll start there with the overall discussion here, Steve. But it feels like volatility has really quieted down. A term I picked up is Goldilocks. Everybody seems to be happy. The soup's not too hot, not too cold. Another term I've used, we're in the eye of the hurricane. So I'm curious, are we living in a fairy tale land or in a fairy tale world, Steve, or are we in the middle of a storm here?
From the Goldilocks perspective of not too hot, not too cold is not entirely unreasonable, right, Kai? Because you look at unemployment, okay, it's crept up 4.2%, creeping up. If you really try hard, you're mind to see it. You can see the beginnings of a mild recession in the US. Inflation has come down, but we're still above the Fed target level, so that's not entirely comfortable. Rates at 4% are up, but we've got real rates at only 1.5%. You put all that together, okay, it's certainly not ringing, alarm bells. But I think that that's not enough to make people completely complacent. I think what exists in too many investors' minds is an overly optimistic view of the future. And we see that really well exemplified in what happened after Donald Trump announced these very high, shockingly high levels of tariffs, which certainly shocked the markets in the early days of April. So what happened there? The VIX went from 20 to 70. Historical volatility actually touched 70, 10-day anyway. Stock market fell 15, 16% in 3 sessions. And then two very unusual things happened. One is that the dollar weakened. It was already pretty soft going into April and then weakened. It's a very, very unusual phenomenon to see the dollar weaken in a period of heightened financial stress. So it suggested to us there may be something truly different going on here. And the other thing is the bond market, having spent 2 days strengthening, suddenly flipped and really started to weaken. So there's some very worrying and unusual things going on in there. Then, Mr. Trump suspends the tariffs, and the market, is delighted, and we bounce. And then we bounce a bit more, and then we bounce a bit more, and then before we know it, not only are we back to the 57, 70 level that the S&P was, but on April the 1st, but we're actually back at 6,000 and approaching a new all-time high. So it's like we priced in a bit of a crisis. Then we decided that because there'd been a postponement, not a cancellation, but a postponement of some of these tariffs, not only were things as good as they had been before they were announced, but even better. And that just seems to me to be a very strange conclusion to come to. So I don't think it's that we're in a macro Goldilocks environment. I think that investors are overly complacent and overly optimistic, and that they are seeing what they want to see in the data.
Give me 60 seconds and I'll show you why you should be buying silver and how to get started. Continuing price spikes in groceries, healthcare, and housing tell the story of inflation, and almost everyone is seeing their dollar purchase less every year. As the reality of inflation sinks in, investors are acting to diversify and protect themselves, their families, and their savings. That's why Money Metals is offering a silver starter kit to help you get started in holding tangible wealth. This mix of our most recommended forms of silver includes 9 silver coins, totaling 4 troy ounces of pure silver. These silver coins are popular and widely recognized, making them easy to sell back for cash too. Low transaction costs and transparent pricing are among the reasons Investopedia calls Money Metals the best precious metals dealer in America. Don't waste any more time. Start protecting your savings today with physical silver at moneymetals.com/go.
Now, really good point, Steve. And maybe we could drill down on that a little bit. It's just trying to understand what the investor is ignoring and why he's so happily ignoring the macro negativity here. Like, let's talk about it. Let's be honest. Like, Israel, Iran is not priced into the markets, in the main market, for example, out of my perspective.
Okay. So there is no one place called the market, and I understand that a lot of your viewers, focus a lot on gold and the gold markets, and I think it's extremely interesting that gold. Here is gold, at an all-time high, and I think most people watching this understand why that is. There's a lot to worry about. Maybe the dollar's role in the financial system is changing. People are looking for alternatives. And gold has a 4,000-year history of being a store of value, a bit longer than Bitcoin, say. And with the dollar starting to behave in this aberrant way, and supply-demand in gold market being tight, there's not that much gold in the world. As I'm sure everyone listening to this knows, you can put all the gold ever mined in the world under the Eiffel Tower in a cube. So a change in appetite has a big change on price. I don't think the people who've been bidding gold up are the same people who've been bidding up US securities again. I think that's a different group of people, and I think their assumptions are overly complacent. And I'll give you a very good example, which is a stock that we focus on a lot as a thermometer for retail sentiment, which is Tesla. As everyone on the planet knows, the world's most powerful man and the world's richest man had a spat when they disagreed about the budget. They both publicly said a lot of inflammatory things about each other, and Tesla's share price fell 14%, and that's a very significant loss of value. And then that was on the Thursday. On the Friday, they didn't say anything rude about each other, and Tesla rose 5%. And then on the Monday, they didn't say anything rude about each other, and Tesla rose 5%. And then on the Tuesday, they didn't say anything rude about each other, and Tesla was back, was up 5%. So in 3 days of them not saying anything rude about each other, Tesla was worth exactly what it had been the day before the spat. And once again, just like these tariffs, we're like, is Tesla now as valuable a company as it was the week before when Donald and Elon were best friends? Or is it now worth less? Investors are saying it's worth exactly the same. Now, those same investors were saying the friendship between Musk and Trump was enormously valuable, right? I mean, they were between 5th of November and the 17th of December, they added $500 billion to the value of the company because the relationship between Elon and Donald was going to be that valuable to the company. Then they fall out, and the share price falls 14%, which is a lot, but it's certainly an awful lot less than before Trump was elected. Stock was 227 at the time, so it still added hundreds of billions of dollars more. And because they have 3 days where they don't say anything rude about each other, it's worth what it was the week before. It's a similarly sort of illogical conclusion. If you're saying the relationship between Trump and Musk is valuable to Tesla as a company, and I'm not sure it is, by the way, but if you're saying it is, then the logical thing is to take it down now that they're no longer friends. The fact that they suspend their abuse for 3 days doesn't unwind the entire diminution of value. So I think this tendency of people to like overprice and to continue to reprice it, the same piece of good news endlessly, is going on in markets, and particularly in the S&P. And yes, you're absolutely right. This recent crisis in the middle, well, it's war, right? So Iran and Israel are now, to all intents and purposes, at war. Oil price goes up at 9%. That's totally logical. Gold goes up. That's totally logical. As a U.S. equity market doesn't care. That's a bit odd. Because, like it or not, it will matter. And then the other thing I think that is also super interesting is, once again, the dollar doesn't bounce. So the dollar's now right back at its year lows, even with this trouble in the Middle East. So what are people seeing? I think that they are seeing what they want to see, Kai. I don't think what they're seeing is logical. I think that the situation in the US economy is hard to read, but I don't think Powell feels he's got enough room to cut rates. Certainly with oil prices up as they are here, he's got less room. So if that's why you're thinking, if you're thinking Powell's going to be cutting rates and that's why you're going to be buying this market, I think you're wrong. I think, if anything, this oil price increase is going to make it less likely. So why doesn't the market care? It's a mystery to me. But, there are significant periods of time where markets will ignore bad news. I'm old enough to remember 1999, 2000, when, NASDAQ just kept on going up despite obviously bad news. And then it didn't. Similarly in 2007, as the clouds gathered over the US housing market kept on going up, and the credit market kept on tightening. So, markets can be overly optimistic for long periods of time. They just can't be in a false state forever. So I think we are setting ourselves up for disappointment. Once again, that's one of the reasons we think right now you want to be revisiting your hedges. And I assume that's why a lot of your viewers are buying gold, because gold has had a very good history of being a store of value. And I think particularly with what we can see as possibly one of the most significant changes in markets in recent years, the changing role of the dollar in people's portfolios could be adding to gold as an attractive hedge, because it clearly is independent of the dollar and is behaving, recently has been behaving more reliably as a safe haven. Will the US go into recession this year? I'm going to say at Vulpes, we are divided. I'm on the I don't know. I don't think it'll go into severe recession. Our head of research says yes, it's very likely. Mostly led by a reluctance of business to invest, and maybe a consumer slowdown. Other of my colleagues feel unlikely. But what we're clearly not seeing is strong growth. We're at stall, right? We're at stall. And what would be the next catalyst for growth? If it doesn't feel like there's a loss of them, yes, okay, we've got this big, beautiful budget coming, which looks more inflationary than anything else to us, as it did to Mr. Musk. So, I suppose if you're a believer, you could believe that the budget's going to be a catalyst. But I think that raises the possibility of a break in the bond market, from low to still low, but less than it was. So, yeah, I mean, overall, I don't think the reason why you want to be increasing your hedges is because the markets are, the economy is about to plunge. Just feel that overall a lot of assets have gotten way too much air in them and speculation, and that it's going to be really hard to fulfill those expectations.
Steve, you mentioned something earlier that I want to come back to real quick. Is US dollar weakened, the bond market weakened, and you were talking about hedging your bets and safe haven investing. I think we can combine these two topics here a little bit, because as you said, like, the currency is not the safe haven anymore. The bond market doesn't seem to be a safe haven anymore. Just this morning, I'm looking at the 10-year yield actually rising at 4.44, which is a bit atypical given the situation in the Middle East that we pointed out. You would expect, and you said the same thing about the US dollar, that there'd be a little strength at least in it, but they seem to have completely lost, and maybe I'm exaggerating a little bit, their safe haven attributes here. And
I think you're
why is that though?
Well, that's the $64 question, kind of. Why? Okay, so if you are a believer in prudent fiscal management, you would look at the US budget and you say, if you want to solidly retain your status for the US dollar as the global currency, then you should not be blithely walking your deficits up ever higher as a percentage of your GDP. Some level of fiscal responsibility is the price you need to pay for being the global reserve currency. And secondly, clearly the current administration, with its emphasis on America first and its message to the world through its tariffs that it's taking a more provocative stance with its allies, is not likely to encourage incremental buyers of the dollar, and probably is driving incremental selling. But if you have driven your debt to GDP up to 125% of GDP and intend to push it up higher by another 3.3 trillion in this current budget, you should not expect your bond market to be the ultimate safe haven, because clearly you are undermining the fiscal strength of your economy. So it's maybe the real question isn't why is this happening, is why didn't this happen before? You never know. Confidence is a strange thing, right? It's there until it isn't. But I think what we are seeing is important and unusual. And the problem for investors is, if the dollar and the US bond market are not your go-to safe havens when you want to raise cash and have a more defensive stance, what is? Because there are really not a lot of other great candidates out there. The euro has gone up this year, but it's hardly a model of fiscal rectitude itself, right? Buying the European bond market, I mean, as a diversification, it might be working, but it doesn't really seem to be fundamentally justified. So there's a real shortage of good alternatives. And that may well once again be why gold has done so well this year, because a relatively small change in appetite for gold leads to a big change in the price. Up and down, remember. I mean, one of the things I do remember in 2008, and I'm sure it was a shock to a lot of people, is that the gold price fell. Ultimately, if people are raising cash because they're over leveraged, they have to sell whatever they have, including their safe havens. So it's not a guarantee, but we have less leverage in the system than we did in 2000, 2007, 2008. Certainly less in the banking system. We may have more than we know of in the private markets. We don't know how much leverage out there is in the private credit market, the private equity market. We can guess, but there's a limit. Because it's private and opaque and not regulated, we just don't know. But I'm assuming that we won't have effectively a massive move towards cash to make margin calls. I just feel that we are in a situation where markets become choppier and more uncertain, and that holding more hedges is a better idea after 10 years of them largely being a waste of money. So, and I do think that what's happening in the bond market, the US bond market, the US government bond market, let's be very specific, US government bond market across the board, but especially the longer end, and the US dollar, highly aberrant. And you've got to, and if you're not worried about it, you should be.
No, really good points there, and maybe we'll come back to the inflation discussion real quick, because you touched on it just very briefly when we touched on oil prices, of course, that have a massive impact now that we've seen a 10% jump in oil prices here again. What do you make of inflation right now, Steve? Like, where are we at? 2.4%, 2.8 on the core. What is your inflation forecast going forward, Steve?
I studied economics. I'm not an economist. I just look at the things that are going to be driving this higher, and you look at the things that will be driving it lower. We had a situation, and talk about a Goldilocks situation, for the first 20 years of this century, where China exported deflation en masse to the world by becoming this incredibly price competitive manufacturing center. And I was based in Singapore for most of that, and I got pretty much a good ringside seat on it. I mean, it was a miraculous thing. A lot of Americans, including Peter Navarro, thought it did an awful lot of harm to a lot of places, including America and manufacturing side. So not everyone saw it as an unequivocal good, but boy, did it actually push the price of stuff down and down and down and down. Now, globalization plus China's mobilizing of hundreds of millions of its agrarian citizens to go and work in factories was like an unprecedented anti-inflationary suppressant one-off, and it's over for lots of reasons. Those people are no longer coming, leaving the fields. In fact, Chinese working population is now in decline, so that demographic boom is like a one-off. Plus the fact the world is clearly was deglobalizing even before the Trump administration came in, and that process increases. Tariffs are inflationary. I may not have a PhD in economics, but I do have a master's degree in economics, and I know that when you actually start taxing people for goods they consume, that's inflationary. So it's hard for me to be sanguine about inflation. I think most people, including myself, have been surprised we haven't seen it yet. But I think the fact we haven't seen it yet doesn't mean it ain't coming. I wouldn't be at all surprised to see inflation pop back up this year, pop back over 3. And I don't think that's going to help markets at all. Powell, I think, already feels he's constrained in his room, despite the fact that Mr. Trump has been very clear what he thinks Powell should be doing. I think Powell's ability to do it is limited, and I do think we'll see a spike in inflation at some point this year, and that will be a shock to markets and will have some consequences. I don't see what brings inflation down from here, right? I mean, everything got very expensive. Then the inflation pressures abated, but where is the deflationary pressure from here? I don't see it. So, inflation has proven to be sticky on the downside, and I think that will continue to be the case. I don't think we'll see quite what we saw in 2022, but we have got a government, with a plan to spend. That's inflationary, as we saw, during the great inflation spike. Eventually, you spend $1 trillion here, you spend $1 trillion there. Sooner or later, you're talking real money. And if that enters the economy, which it didn't in 2008, I'll come back to that in a second. It didn't, but whereas for the COVID stimulus, it did, then it will have inflationary consequences. So the big question is, and I will admit that I was worried about inflation in 2008, given what was happening with, the widespread printing of money. TARP was, into 800 billion was just the beginning. Why was I wrong? Because none of that money went into the general economy. It just went into this black hole of bank losses and disappeared. So there was no multiplier effect on that. It was a sort of sterile intervention, if you like. Whereas the COVID intervention clearly went into people's pockets. paying people money to sit on their sofa and watch Netflix turns out to be inflationary because they're not producing goods, but you are giving them money, and eventually you have too much money chasing too few goods. Okay. I think that situation is still out there broadly, and I think the full inflation implications of that are not fully factored in. And I can't see what's going to drag, other than a recession, can't see what's going to drag the US inflation rate below the Fed target.
So maybe what you're saying as well, maybe to turn it around, because something that forced you to close down or not forced you, but made the decision probably easier to close down the volatility fund back in 2011 was the excess amount of liquidity, meaning the effects of QE. Do you see QE coming back in that regard, given the inflationary environment that you just predicted?
No, I mean, I think it would be. I mean, you could never say never, Kai. I mean, the central banks are full of people who love printing money. There are hundreds of PhD economists working in these research departments, and we've had some pretty wacky ideas out of them over the years, right? Modern monetary theory and so on, saying it doesn't matter how much money you ever print, you'll never get adverse consequences. Never say never, but given what we've experienced, having seen inflation spike, having seen the damage it did, my personal view, is why did the Democrats lose the election in November? My personal view is overwhelmingly it was inflation. The basket of goods for the average American went up by a lot, probably a fair bit more than the CPI would suggest, and that as a consequence, they wanted to see the back of the Democrats because they felt that they'd economically harmed them, despite the fact that it looked like it was relatively high levels of employment, and there had been wage rises. So I don't think any government should be blithe about the damage to their popularity that inflation will do. So I would expect that unless it was seen that there was no other choice and that we actually having, say, panic in systems, that QE will be a much, much less used instrument than it has been in the past. We can't be. I don't think after the great success of 2008, I think central banks were overly confident that they could print money without consequences. I don't think that exists anymore. I think that now we are in a situation where people know that there are consequences, and that some of those consequences are very serious. And in the Democrats' case, I think that's why I personally believe that's why they are not in power. So no, I would expect that it would take a proper crisis to bring that out in the central banks, which comes back to my general sort of view that the central banks have, including the Fed, have way fewer arms in their arsenal than they did, or that maybe a lot of people are assuming, and that with the Fed unable or reluctant to act, and a lot of people relying on the Fed. But I mean, if you look at the way the 2-year behaved during those 3 days of falls in April, the 2-year went down to 3.6, and people were saying we're going to get 5 rate cuts this year. We're like, are you crazy? It's like inflation's knocking on the door of 3. Where are these five rate cuts coming from? Apart from the fact that, well, I want them, right? I mean, it's like, Donald Trump has actually said it. It's like, I'm a real estate guy. I like low rates. You're like, yes, but just because you want something doesn't mean you should have it. America is not going. America will not be strengthened by more money printing, and so I don't think it will get it. We don't know who the replacement chairman's going to be. It seems that the sack Chairman Powell movement is for the moment suspended. I don't see where the next rate cuts are coming from. Maybe we get a lull in inflation and they get 1 in, but 5? No, crazy stuff. So we're going to have to live with the consequences of our actions. There's not going to be a sugar daddy there to save us from our mistakes and flood the market with liquidity and push everything back up. Coming back to my original proposition of 32 minutes ago, that's why I think we're going to get more volatility.
No, perfect. Like maybe 0.2% chance of a Fed hike, actually, as per CME Fed Watch tool as well.
Yeah, I
think you
mean,
ruled out a cut at this
I would
point.
say, I mean, I would kind of cheer it just for the courage of it, given the amount of abuse he's going to get for it. But maybe that's what's required. You know, I mean, clearly, he's no Volcker, but maybe that is what's required to put some faith back into, say, the US dollar or the US bond market, that we're actually going to see some hawkishness from the Fed. But I would literally fall off my stool if he did it.
It'd be hilarious. It'd be fun. It'd be fun to see, because I'm pretty sure somebody in the White House will call the Supreme Court rather quickly to figure out how we can change the situation there at the Fed, right? Maybe Steve, like I forgot to ask you one more thing here before we come, like how you plan to play this volatility that you see coming up here, is really the tariff resolution. Like, how do you see that play out? I mean, look, there are both general and specific things to do. I mean, the instruments we had available to us in 2007, 2008 were, there's quite a few of them still around. I grew up in an age where, calls and puts were, your core instruments. There's a tremendous amount of liquidity in those still. The average maturity of those has come down a lot as retail decided to use them to speculate, but there's still a lot of liquidity in the options markets. And options markets remain a good, solid place to start. More esoteric things like credit default swaps, which were very useful in 2008. Boy, were they useful. Are still around, but the depth and liquidity in the volatility markets, or the option markets in, say, foreign exchange and bonds is still really excellent. So there's a wide variety of instruments. What's available to a hedge fund is not necessarily available to the retail investor, but there has been a huge growth in ETFs that allow a thoughtful and diligent investor to find hedge fund-like instruments through the ETF market. But I think my personal belief is that the riskiest marketplace in the world right now is, because it's so over-owned, is the US equity market, and I'd start there. But I think there's multiple points of fragility: US dollar, Japanese yen, US dollar, euro, credit default swaps on an awful lot of things, and in the mining complex itself. I think there's a lot that can be done. Call options on gold seem like a pretty good idea, given what we've already seen and given what we know about the imbalance that can very quickly appear between supply and demand in the gold market. So yeah, I think the mistake is, if you are looking for hedges to be brought to be overly narrow, unless you have something that you're significantly overweight that you want to hedge. I think it's the right thing to do is to look for things broadly, and one of the things to do is to raise cash as well. And if you're holding your cash in a number of different ways, including monetary metal, then I think that's a good hedge too. But I want to just emphasize, we're not doing this because we're massive bears. We've got quite a lot of money invested in the market, in private equity, biotechnology companies, wide variety of assets. The reason you get a hedge, you put on a hedge, isn't because you're a bear. If you're a bear, you go short. The reason you put on a hedge is because you've got exposure, but you're concerned about it. It's not necessarily your base case, but you think that there's a material chance that things could become worse. And so that's why it's a hedge. Your position is your position. Your hedge is, what if I'm wrong? And I think the chances that we're going to get choppier markets and more frequent market retracements, or I think those do go up, and that's why we are strongly in favor of we're advocating people to look again at the business of hedging, because a lot of people have just simply stopped, and in the case of our specific fund, to be narrowly exposed to instruments that will thrive and go up in value if that volatility goes up, which will normally be consistent with markets coming down. No, fantastic. Steve, I've tremendously enjoyed our conversation. I really appreciate your insights here. And about the $64,000 question, that's why I called you. That's why we had him on. You were my telephone joker here, or my StreamYard joker. So really appreciate you coming on. Where can we send our audience to follow more of your work, Steve?
Well, we have a website, and we'd be delighted to engage with a dialogue with people. We learn a lot from people contacting us. I mean, our investors are always smarter than we are because they have a much more specific and broad-based knowledge. So yeah, info at our traders. We would be delighted to hear from people.
Fantastic, Steve. Really appreciate your time. Thanks so much for coming on. We'll have to do this again soon. Maybe after the summer, we'll catch up in the early fall, see where we stand. So
thanks, Guy. Good luck, and good luck to your viewers.
No, really appreciate that, Steve, and everybody else. Thanks so much for tuning in here to Soar Financially. Really, really interesting conversation with Steve Diggle here. Make sure to follow him. Go check out Vulpes Investment Management as well. Really good insights. Have to get him back in September, October to see where we stand. Maybe after the September FOMC meeting, we'll see what we got. Is the predicted rate cut happening or not? So lots going on. Make sure to follow us. Hit that like and subscribe button. It's a free way to support our channel. We come up with a lot of actual, factual, and timely conversations here on this channel that you can use to make educated investment decisions, I hope. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially. Take care out there.